ever feel like the market's speaking a language you just don't get? Like there are these secret handshakes going on and you're left out.
Oh, absolutely. It can definitely feel that way, like everyone else is in on some inside joke, right?
Exactly. But what if we could decode those signals? That's what we're diving into today, technical analysis.
And we're doing it jargon-free.
No Greek letters, promise. We're talking charts, trends, and practical takeaways for making smarter investing decisions.
Think of it like this. You wouldn't navigate a city without a map, right?
Or at least not a very well-planned trip, right? Some of us like to get lost, but...
Fair enough. But in the market, charts are our maps. Technical analysis is all about using those maps, those charts, plus other clues we call indicators.
Like breadcrumbs someone left behind.
Exactly. To understand where the market's been and hopefully get a sense of where it might be headed.
Okay, so no crystal balls, but we can learn to read the signs. Where do we even begin?
At its core, technical analysis uses these charts and indicators to understand price movements, like you said. It's less about, predicting the future with absolute certainty and more about recognizing patterns.
So kind of like deciphering the market's psychology based on its behavior.
Spot on. Imagine you're a detective. You walk into a room and there's a broken vase, maybe some footprints. You're not just going to say, oh, guess I'll never know who did it. You look for clues, right?
Exactly. So charts are our evidence board then.
Exactly. And just like detectives have fingerprints, we have chart patterns. Each type of chart, like your basic line chart or the more visual candlestick chart, offers a different perspective on how prices are moving.
Candlestick charts. Those sound cool.
They're great. They really give you a lot of information at a glance. They show you 4 key things: where the price of a stock opened, where it closed, and the highest and lowest points it reached during a certain time period. It's all there in a single candlestick. But here's where it gets really interesting. Imagine you're looking at a map of a city. You can zoom in to see individual streets, right? See what's happening on like a street corner by street corner basis. Or you can zoom out to view the entire city. Choosing a time frame for your chart, whether it's daily, weekly, or yearly, is like adjusting that zoom lens on the market.
So what looks like a huge price swing on a daily chart might just be a blip when you're looking at the yearly trend.
Exactly. Perspective is everything. And just like a detective looks for signs of forced entry or, something out of place, we pay attention to volume.
Volume.
Right. How many shares of a stock are being traded? High volume often means there's strong conviction behind a move, whether it's buyers rushing in or everyone heading for the exits.
Got it. So high volume is like finding a crowd gathered at a crime scene. Something big must be happening. Okay, we've got our charts. We're understanding time frames and volume. What about those other clues you mentioned earlier, the indicators?
Indicators. Think of these as our detective's toolkit. They help us analyze those chart patterns, the volume, and see if we can get a read on what the market might be thinking. Let's start with moving averages.
Okay.
Moving averages are just what they sound like. They take the average price of a stock over a certain period of time, say 50 days or 200 days, and plot those averages on a chart. It's like seeing the forest for the trees.
So it smooths out all the day-to-day noise and gives you a sense of the overall trend.
Exactly. Is the market heading up, down, or just taking a breather? Moving averages can give us clues. And then there's RSI.
RSI?
Yeah, the Relative Strength Index. This one's all about momentum. It measures how quickly and how strongly prices are moving to give us some idea of whether a stock is overbought or oversold.
Okay, so think of it like checking the engine temperature of a car. Too hot, and it might be time to cool down. Too cold, and it might need a jump start.
Love that analogy. It's a great way to think about it.
So we're watching for stocks that are either revving up too quickly or stalling out. Got it. But even with trend lines and momentum checks, prices don't move in one direction forever, do they?
You're absolutely right. Even the best detectives hit roadblocks. That's where support and resistance come in.
Okay, explain those.
Support acts like a floor. It's a price level where, historically, buyers have stepped in and pushed prices back up. Resistance is the opposite. It's like a ceiling where selling pressure tends to emerge and push prices down.
I'm picturing like a bouncing ball as its high points and its low points.
Perfect analogy.
Yeah.
Support and resistance help us visualize those potential turning points.
So those levels could indicate buying or selling opportunities, depending on the trend and what the other indicators are telling us, right?
You got it. Now, I do want to say, early in my trading career, I thought I had it all figured out. I spotted this stock with a classic double bottom pattern.
Double bottom.
Yeah, it's exactly what it sounds like. The stock price bounced off a support level twice, like it was trying to find its footing.
Yeah.
All the signs pointed to a breakout, so like I went all in.
Bold move.
Too bold, as it turned out. Here's the thing. I hadn't considered the overall market sentiment. A big piece of news hit, the market tanked, and even though my chart was technically right, I took a loss because I didn't consider the bigger picture.
Wow. So even with the best analysis, there's always an element of risk.
Always. Technical analysis is powerful, but it doesn't eliminate risk. That's why understanding and managing risk is, like, crucial. Think of it as another tool in your toolkit.
You mentioned a toolkit. What tools should we be using to manage risk?
Well, stop-loss orders are a big one. These are like setting a safety net on your trades. You determine a price level where you'll exit the trade if the stock moves against you, limiting those potential losses.
Smart. So you're not just holding on, hoping for the best when things are going south.
Exactly. Then
Yeah.
there's position sizing. Never put all your eggs in one basket, right?
Right. No matter how good something looks.
Yeah, exactly. Figure out how much you're comfortable risking on any given trade and stick to it regardless of how confident you feel.
It sounds like discipline and a clear strategy are just as important as reading the charts. So much great stuff here. As we wrap up, what's one piece of wisdom you wish you knew when you were starting with technical analysis?
Oh, that's easy. Patience. It's tempting to chase every exciting chart pattern, but honestly, technical analysis is a skill. It takes time and practice. Don't get discouraged if you don't become a master chartist overnight. Start small, master one indicator, then add another.
It's a journey, not a race. We've explored the fascinating world of charts, indicators, and risk management through the lens of technical analysis. As we wrap up, one final thought. If technical analysis is about reading the market's mind, how much can we truly know about its next move? Keep exploring, keep learning, and join us next time as we take another deep dive into the world of finance.